On the morning of August 15, 1971, the global monetary system crossed a threshold from which it would never return. President Richard Nixon appeared on television and announced that the United States would no longer honor the convertibility of dollars into gold. The decision was framed as temporary. It was presented as a defensive maneuver against currency speculators. But what followed was not a restoration of the old order. What followed was the construction of an entirely new architecture, one built on confidence rather than constraint, and on the assumption that discipline could be maintained without enforcement. 54 years later, that assumption is being tested in ways that most participants in the system do not yet recognize. Silver sits at the intersection of two conflicting realities. It is traded as a financial instrument, subject to leverage, speculation, and the structural mechanics of futures markets. But it is also a physical commodity with industrial applications, finite supply, and a historical role as monetary metal. When these two realities diverge, the result is not gradual adjustment. The result is violent recalibration. What happened in the overnight session was not an isolated event. It was a symptom of a system that has been building pressure for years, and the pressure is not being released. It is being redistributed. The crash occurred without a single definitive headline. There was no geopolitical shock, no central bank announcement, no corporate bankruptcy. This absence of narrative is itself the message. Markets that move violently in the absence of news are markets where the underlying structure has become unstable. The trigger is irrelevant. What matters is that the market was positioned in a way that made collapse inevitable once a certain threshold was breached. This is not speculation. This is observable in the pattern of stop losses, the clustering of leverage positions, and the thinness of liquidity during off-peak hours. The market did not fall because of a reason. It fell because it was designed to fall once the conditions aligned. History provides the blueprint. In September 2011, silver experienced a similar collapse after a parabolic rally. The metal had climbed from under $20 to nearly $50 in less than 6 months. Then, within days, it lost more than 30% of its value. The catalyst was described as a margin hike by the CME, but the real cause was structural. Too many participants were positioned the same way. Too much leverage was concentrated on one side. The system responded by liquidating the weakest hands first, and the liquidation became self-reinforcing. The same pattern appeared in 2008, when silver fell from $21 to under $9 in a matter of weeks. The same pattern appeared in 1980, when silver collapsed from $50 to $10 after the Hunt brothers' attempt to corner the market ended in forced liquidation. Each time, the mechanism was identical: leverage, crowding, and a triggering event that exposed the fragility of the structure. What makes the current environment distinct is not the pattern itself, but the scale of the imbalances surrounding it. Global debt has reached levels that would have been considered unimaginable a generation ago. Central banks have expanded their balance sheets to magnitudes that dwarf anything seen in prior cycles. Fiscal deficits have become structural rather than cyclical, and the assumption that these deficits can be financed indefinitely without consequence is now embedded in policy. Silver is not immune to these forces. It is a byproduct of them. When confidence in the stability of the monetary system begins to erode, participants seek alternatives. When alternatives become crowded, they become targets for liquidation. This is not a failure of the asset. This is a function of how markets operate under conditions of systemic stress. The overnight crash was not a random fluctuation. It was a forced deleveraging event. The market identified a concentration of stop orders below a key support level, and once that level was breached, the cascade began. This is how thin markets operate. They do not glide smoothly from one price to another. They gap through zones where liquidity does not exist. The gap itself becomes the message. It tells you that there were no buyers willing to step in at intermediate prices. It tells you that the market was waiting for a lower level before demand would materialize. And it tells you that the structure was fragile enough that a relatively small amount of selling could trigger a disproportionately large move. What happens next depends on two variables. The first is whether the market can reclaim the zone that was broken. Support, once lost, becomes resistance. If price returns to that zone and is rejected, the signal is clear. The breakdown is confirmed, and the path of least resistance is lower. If price reclaims that zone and holds above it, the signal changes. The market is telling you that buyers are willing to defend the new structure, and that the flush may have cleared enough leverage to allow for stabilization. The second variable is whether physical demand diverges from paper price. If premiums remain elevated while spot price falls, it indicates that the paper market is disconnecting from the physical reality. If premiums collapse alongside spot, it indicates genuine liquidation and a reassessment of demand. The challenge for most participants is that they are not prepared for this kind of volatility. They entered positions based on narratives rather than structure. They assumed that because the long-term thesis made sense, the short-term path would be linear. But markets do not reward assumptions. Markets reward preparation. And preparation means understanding that silver has always been an asset that punishes emotional conviction. It has always been an asset that moves in ways designed to exhaust the majority before delivering the move that everyone was waiting for. This is not cruelty. This is structure. The market operates on incentives, and the incentive is to shake out weak hands before allowing the next phase to develop. The pattern is not new. In 1792, the United States passed the Coinage Act, establishing a bimetallic standard that defined the dollar in terms of both gold and silver. The ratio was fixed at 15-1. Within decades, that ratio became unsustainable. Silver flowed out of the country because it was undervalued relative to gold. The fixed ratio created an arbitrage opportunity, and arbitrage always wins. By 1873, silver was demonetized entirely in what became known as the Crime of 1873. The decision was framed as a technicality, a minor adjustment to align with global standards. But the consequence was deflationary collapse for debtors and a concentration of monetary power in the hands of creditors. The system was not broken by accident, it was broken by design, because the incentives of those controlling the system were not aligned with the incentives of those depending on it. The same logic applies today. Silver is priced in a futures market where the vast majority of contracts are settled in cash rather than physical delivery. This creates a structural separation between the paper price and the physical reality. The futures market is efficient for price discovery when participants intend to take delivery. But when participants are purely speculative and when leverage amplifies their positions, the price becomes a function of positioning rather than supply and demand. This is not a conspiracy. This is how derivative markets function. They are designed to manage risk, but when they become larger than the underlying market, they no longer reflect reality. They create reality. What makes this relevant now is that the gap between paper and physical has been widening. Industrial demand for silver has remained robust. Photovoltaic solar panels require silver, electronics require silver, medical applications require silver, yet inventories at exchanges have been declining. Refineries have reported tightness in certain product categories. Mints have struggled to meet demand during periods of elevated retail buying. None of this prevented the overnight crash. None of this stopped the paper market from liquidating positions with extreme prejudice. Because in the short term, price is determined by whoever is forced to sell, not by whoever wants to buy. The historical precedent is instructive. In the 1930s, the United States government confiscated gold from private citizens at $20.67 per ounce, then immediately revalued it to $35 per ounce. The justification was economic stabilization. The result was a transfer of wealth from individuals to the state. In the 1970s, after gold was delinked from the dollar, the metal experienced a parabolic rise followed by a brutal collapse. The collapse was facilitated by coordinated central bank selling and the introduction of futures markets that allowed for price suppression through leveraged short positions. In both cases, the mechanism was different, but the outcome was the same. The market was structured in a way that allowed concentrated interest to shape price in their favor, and the majority of participants learned too late that holding the asset was not enough. Timing, structure, and understanding the rules of the game mattered more. Silver is now caught in the same dynamic. The rally that preceded the crash was built on a foundation of dip buying and trend following. Each pullback was shallow. Each recovery was swift. This trained participants to expect support. It conditioned them to believe that the correction would always be brief. But markets do not operate on conditioning. They operate on liquidity, leverage, and the distribution of positions. When too many participants are positioned the same way, the market has an incentive to move against them. When leverage is high, small moves become large moves. When liquidity is thin, large moves become catastrophic moves. This is not market manipulation. This is market mechanics. The question is not whether silver will recover. The question is whether the recovery will occur before the broader system experiences a more severe dislocation. If confidence in fiat currencies continues to erode, if fiscal imbalances continue to widen, if monetary expansion continues without discipline, then the demand for real assets will eventually overwhelm the capacity of paper markets to suppress price. But that eventual reckoning does not prevent intermediate pain. It does not prevent months or years of frustration. It does not prevent the kind of volatility that forces participants to question their thesis at precisely the moment when conviction is most necessary. The overnight crash was a warning. It was a reminder that the system is fragile, that leverage is dangerous, and that narratives do not protect against mechanical liquidation. The market does not care about long-term fundamentals when short-term positioning is lopsided. The market does not care about industrial demand when futures contracts are being dumped into thin order books. The market cares about survival, and survival in a leveraged system means liquidating the weakest participants first. What remains to be seen is whether this was a final shakeout before the next leg higher, or whether this was the beginning of a deeper correction that will test the resolve of even the most committed holders. The answer will not come from headlines. It will come from structure. It will come from whether the broken support zone is reclaimed, whether physical premiums hold, and whether the market can stabilize without another wave of forced selling. Until then, the only certainty is that the system remains unstable, that the imbalances remain unresolved, and that the next shock will arrive when the majority least expects it. History does not repeat precisely, but it rhymes with enough consistency to serve as a guide. And the rhyme that matters now is this: systems built on leverage and confidence eventually collapse under their own weight. The only variable is timing.